To me, consumer choice in mortgage markets means the emphasis on that is understanding what features of the mortgage market and mortgage products interact with the macroeconomy to understand how consumers are affected. One reason why consumer choice in mortgage markets would matter for a given family or a given household is that in an environment of falling interest rates, if they have an adjustable rate mortgage, well then they're able to just immediately have lower monthly payments. If they have a fixed rate mortgage and interest rates are falling, then they're going to need to refinance to do that, and there could be frictions associated with refinancing. The main question in my research is understanding how segmentation in the mortgage market interacts with decisions that a central bank might make. So for example, say a central bank is going to take an action to change the yield curve and to change the structure of interest rates in the economy. Who does that benefit? What kinds of borrowers are able to benefit from that? So by the yield curve, what I mean is the interest rate structure that exists in the economy over the life cycle of a bond, for example. If the mortgage market were wholly unsegmented, then every borrower would be able to benefit equally. If there are frictions in the mortgage market and some sectors or corners of the mortgage market are able to benefit more than others, then my research looks to understand why is that and what are the implications of that. There are several findings of my research. One is that when the central bank decides to purchase assets to change the yield curve, my research shows that it really matters what the central bank purchases. So just purchasing government debt will have a very different effect from purchasing, for example, mortgage-backed securities. A second related finding in my research is that there's a very large scope for countercyclical macroprudential policy. So by countercyclical macroprudential policy, I mean policies that during good times tighten credit conditions and during bad times, during recessions, for example, loosen credit conditions. One benefit of this kind of countercyclical macroprudential policy and of central bank actions is that you induce several cash-out refinances by households, and that equity that households are able to withdraw through the cash-out refinancing process is tremendously valuable at stimulating consumption and stimulating the real economy. So I think there are a few policy takeaways from this. One is that if the central bank is going to be in the business of buying long-term assets, long-duration assets at large scales, such as has been done by the ECB and by the Bank of England, by the Bank of Japan, by the Federal Reserve in the United States, it's crucial that they focus on originating the kind of debt that would not be originated otherwise. Another policy implication of my work is this idea of having mortgage market policy that complements macro policy. So you might have monetary policy or other fiscal policy that's trying to affect the entire macroeconomy. Its effectiveness is going to be modulated by mortgage market policy and things like do you allow people that are underwater to be able to refinance? Do you allow people that have low equity to be able to refinance? Do you loosen credit conditions at this time to allow that aggregate policy to have more of an effect on the particular households or geographies that need it the most?